Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Travel + Leisure Co. quarterly report. Travel + Leisure Co. offers a diverse range of businesses and services, including vacation ownership interests, VOIs, sales consumer financing, for VOI purchases property management services, at resorts 3 vacation exchange, brands travel technology platforms, travel memberships direct-to-consumer rentals, private label travel booking technology solutions. These services cater to various aspects of the hospitality and travel industry, providing customers with a comprehensive range of options for their leisure needs. The recent surge in Travel + Leisure Co. stock price can be attributed to several key factors. The company's robust third-quarter earnings, exceeding Wall Street expectations, led to a significant increase in the stock price. Additionally, raised full-year guidance further boosted investor confidence. Strong financial health and profitability, as well as the resurgence of the travel industry, have also contributed to the stock's growth. Strategic initiatives and partnerships, such as digital innovation and collaborations with brands like Sports Illustrated, have further driven the company's success. Overall, Travel + Leisure Co.'s strong performance has led to a 44.95% increase in its stock price over the past year. The primary drivers of revenue growth or decline in the company's financial performance can be summarized as follows. Revenue growth is primarily driven by an increase in vacation ownership interest sales, service and membership fees, higher VPG due to increased owner upgrade transactions and tour, and increased commission revenues. The vacation ownership segment saw a significant increase in gross VOI sales, while the travel and membership segment experienced growth in total transactions. On the other hand, revenue decline is attributed to decreased revenues at the travel and membership segment due to lower exchange transactions and revenue per transaction, as well as a decrease in average number of exchange members. The decline in exchange transaction, revenue, and travel club revenue per transaction also contributed to the overall decline in revenue. In net income and profit margins, a mixed picture. The financial summary reveals a mixed picture of net income and profit margins. For the 3 months ended September 30, 2025, net income increased to $111 million from $97 million in 2024, while for the 9 months ended September 30, 2025, it decreased to $291 million from $292 million in 2024. Profit margins also showed a mixed trend. The operating income margin decreased to 20.6% in the 3 months ended September 30, 2025, compared to 19.1% in 2024, but increased to 19.2% for the 9 months ended September 30, 2025, from 18.3% in 2024. The net income margin showed a similar trend, increasing to 10.6% in the 3 months ended September 30, 2025, compared to 9.8% in 2024, but decreasing to 9.7% for the 9 months ended September 30, 2025, from 10.1% in 2024. The reasons behind these changes are varied. The increase in net income was partly due to a gain on disposal of discontinued business in 2024. However, this was offset by increased provision for income taxes and decreased interest income. The company is experiencing a significant improvement in its financial performance, as evident from the increase in positive operating cash flow. In 2025, the company generated $123 million in operating cash flow, a notable rise from $95 million in 2024. Furthermore, net cash provided by operating activities also saw a substantial growth, increasing to $516 million in 2025 compared to $366 million in 2024. This upward trend indicates that the company is successfully generating sufficient cash to meet its operational needs and invest in future growth initiatives. The company's debt level and interest expenses have undergone significant fluctuations over the past year. While there are discrepancies in the reported figures, it appears that the total debt has increased from $3,468 million in 2024 to $3,579 million in 2025 as of September 30. However, this increase is largely due to new term notes payable and conduit facility renewal, offset by the redemption of existing secured notes. Interest expenses have also been inconsistent, with some instances showing a decrease and others an increase. Notably, interest expense decreased from $63 million in 2024 to $60 million in 2025 for the first 9 months, but but increased significantly to $175 million for the year-to-date period, excluding non-recourse vacation ownership debt. Overall, while there are variations in the data, it seems that interest expenses have generally remained stable or decreased slightly. The company's financial performance varied across its segments and regions. The vacation ownership business was a standout performer, generating significant revenue and adjusted earnings before interest, taxes, depreciation, and amortization (EBITDA) across multiple pages. In contrast, the travel and membership business struggled, with low adjusted EBITDA figures throughout the report. Management's outlook and strategy. The company's management is optimistic about its future prospects, driven by continued demand for leisure travel in the vacation ownership segment. They expect consumers to recognize the value proposition of their products during periods of inflation, leading to growth through owner upgrade transactions. The strategy involves expanding into broader leisure travel industry through travel clubs and growing cornerstone timeshare and exchange businesses. Management is confident about meeting its short-term and long-term cash needs, with sufficient liquidity to invest in select capital and technological improvements. They aim to optimize cash flow and adjusted EBITDA while deploying capital for the highest possible returns. The company will maintain a focus on asset-light efforts and strategic investments with financial partners to support vacation ownership sales. Overall, management's outlook is positive, with a focus on growth, optimization of cash flow, and strategic investments to drive business expansion. Acquisitions and divestitures overview. The company has made notable acquisitions to enhance its business. One significant acquisition is the Travel Plus Leisure brand, which was acquired as mentioned on page 55. Additionally, there are references to other acquisitions in Note 5 on page 17. On the other hand, divestitures have been proposed but not yet executed. The Strategic Resort Restructuring Plan, outlined on page 56, involves removing select resorts from the company's portfolio. However, no actual divestitures were mentioned in pages 34, 39, and 50. The company has a history of rewarding its shareholders through both dividend payments and share buybacks. In terms of dividends, the company paid out $36 million for the 3 months ended September 30, 2025, and $114 million for the 9 months ended on the same date in 2025. This trend is consistent with previous periods, including the 3 months ended September 30, 2024, where $35 million was paid out. In addition to dividend payments, the company has also been actively buying back shares. In 2025, a total of $211 million was spent on share buybacks, although the exact number of shares repurchased is not specified. Concerns about inventory buildup and supply chain disruption are mounting. The company's completed VOI inventory has increased by $28 million, while unregistered VOI inventory remains a concern despite some decrease. Inventory impairments of $6 million further highlight the issue. Additionally, unsold VOI's maintenance fees total $146 million, indicating potential losses. Meanwhile, supply chain disruptions loom due to elevated delinquencies in the loan portfolio and uncertainty caused by recent tariff actions and trade restrictions. That concludes the financial summary for Travel and Leisure Co. Feel free to comment below, and I will be happy to answer them when possible.